On Friday, we put a number on the chart, $95 on WTI. That was the tape reading objective. Sunday open, oil gapped straight to $98, cleared $95 within the first minutes, and did not stop. It ran all the way to $120, a 30% surge in under 24 hours. And then, in under 4 hours, it reversed 18% off that high. One of the largest single-session crude oil reversals in modern market history. Both directions, same session. If you were watching, none of that should have surprised you, because we told you something else on Sunday that matters just as much as calling the move. We said, do not chase the gap. Do not buy the spike. Wait for structure. The people who chased oil at $120 learned why that rule exists. The people who waited are now watching from a much cleaner position with a much better read on what comes next. That is the difference between reacting and reading. This entire video is built around that difference. Stay in. Every part builds on the next. Let us build the complete picture of what happened to oil, because the headline tells you the price, not the structure. The Strait of Hormuz closure triggered the worst global energy crisis since the 1970s. Bahrain's state oil company declared force majeure after Iranian strikes set its only refinery on fire. Iraq's production collapsed roughly 60% as tanker movement was blocked. Saudi Aramco's Ras Tanura refinery, Saudi Arabia's largest, was forced to halt operations after last week's strike. Aramco is now rerouting supertankers through Red Sea facilities on Saudi Arabia's west coast to bypass Hormuz entirely. 8 supertankers already loaded this month, on pace for a record. That was the supply picture driving oil to $120. Now here is what reversed it, and more importantly, what that reversal actually means. The G7 and the International Energy Agency announced a coordinated release of up to 400 million barrels from strategic reserves. That headline moved oil 18% in under 4 hours. But let us do the arithmetic the mainstream is not doing. Global oil demand is approximately 100 million barrels per day. 400 million barrels is 4 days of global consumption. The Strait of Hormuz carries roughly 20 million barrels per day, so 400 million barrels covers approximately 20 days of strait traffic. Not months, not a structural solution, a window of roughly 3 weeks. And here is the detail that changes everything. France's trade minister stated publicly that the G7 is not there yet on actually releasing the stockpiles. 3 countries, including the US, expressed support. The others have not committed. The IEA nations hold 1.2 billion barrels in total. This release would consume nearly 30% of the entire collective stockpile. What moved oil 18% off its high was the possibility of a release. Not a confirmed release, not an agreed release, a possibility. That is the market you are operating in right now. One unconfirmed statement moved the most important commodity on Earth by nearly a fifth in 4 hours. Respect what that means for volatility in every direction this week. The geopolitical architecture underneath all of this is not simplifying. It is splitting. France announced it will deploy 8 warships, 1 aircraft carrier, and 2 helicopter carriers to the Mediterranean, Red Sea, and Strait of Hormuz. A ship escort mission to attempt a physical reopening of the shipping lanes. India's government officially stated it will not release its own strategic crude stockpiles. Trump said publicly the war will continue for a while. When pressed on timeline, said whatever it takes. 3 words that are not a de-escalation message. That is a war economy signal. The US has spent approximately $6 billion in the first week alone. $4 billion on munitions, mostly missile interceptors. Iran has selected Mujtaba Khamenei as its new supreme leader. Trump stated publicly he is not happy with that selection. Israel immediately stated it will target every new leader Iran appoints. Iran declared it is prepared for full-scale war. And while the West coordinates a reserve release, satellite trackers confirm Iranian oil is still flowing, primarily east, to China, through the very strait everyone else is scrambling to manage. The West is coordinating a reserve release. India is opting out. France is preparing a military escort. And China is receiving oil through the route the others cannot use. These are not parties playing the same game. They are playing completely different games on the same board. Understanding that split is more important than any single price level this week. Now here is what sustained high oil does beyond the energy market, because this is where metals, rates, and every other asset class connect. If WTI sustains near $120 for 3 months, US CPI inflation pushes to approximately 3.7%. That would be the highest inflation reading since September 2023, into a war economy. With the Federal Reserve already navigating mixed signals on growth and price stability, the Fed cannot cut into 3.7% inflation without risking currency credibility. It cannot hike into a war-driven economic slowdown without accelerating the deterioration. That is not a corner. That is a sealed room with the options running out. And the bond market is already pricing that tension. Yields are mixed right now, not because the market is confused, but because it is genuinely trying to price both inflation and recession at the same time. When bonds cannot decide, that is not noise. That is the market telling you the situation has no clean resolution. WTI is currently sitting around $100, back inside the gap it created at Sunday's open. That is a structurally healthy position for a market that just absorbed an 18% reversal. If the underlying supply disruption continues and the G7 release does not resolve it, oil can spike again. The March 2022 high was $130. If $100 holds as a floor and the strait remains restricted, that level comes back into discussion on its own. You do not chase the spike at $120. You watch what happens when it settles. The gap it is sitting in right now is the gap it created. That is where structure lives. Now, why did gold and silver drop when oil spiked? Because that is not how safe haven mechanics work in real time when a shock hits. What happened to precious metals in the opening hours was not a demand collapse. It was deleveraging. Gold dropped 2% in the opening hours. Silver dropped nearly 4%. Together, roughly $885 billion in market cap erased in the first 120 minutes. The Nasdaq, S&P, Dow, and DAX all opened lower simultaneously. Here is the exact mechanism. When a macro shock of this magnitude hits, funds facing losses in energy positions, equity positions, and leveraged macro books need to raise cash immediately. Margin calls do not wait. The first assets sold are the ones that are liquid and still showing a profit. Gold and silver had been performing, so they got sold. Not because they were weak, but because they were the most available source of gains to liquidate against losses elsewhere. That is deleveraging. Not a verdict on gold or silver, a mechanical consequence of where the profits were sitting. And the fact that gold outperformed silver in that initial flush is not a coincidence. It is a textbook signal of defensive repositioning. When silver falls harder than gold in a deleveraging wave, it is not because silver is structurally weaker. It is because silver carries industrial demand sensitivity alongside its monetary demand. In a growth shock, industrial demand gets repriced downward simultaneously with the monetary demand being liquidated. Gold does not have that industrial layer, so gold holds better. Silver drops harder. That is the mechanism. Understanding it means you do not panic at the wrong moment. Silver is sitting at $84 Western spot right now. If you were watching the Sunday open, you saw it drop to $79. A $6 flush in the opening hours. It clawed back every cent, and it is sitting right back at $84. But here is the structural observation that matters more than the recovery. The $85 level has now rejected price 4 times. 3 times on Friday, once again today. The dollar gapped higher at Sunday's open, then retraced back into that gap, and silver still could not close above $85. This is not a dollar story. If it were, silver would have broken $85 when the dollar pulled back. It did not. That is a structural ceiling holding regardless of what the dollar does underneath it. Until $85 breaks with conviction and holds on a closing basis, the range is defined. Shanghai closed physical silver at $96.85 today, up 1.7% on the session. The $12 gap between what Western paper claims silver is worth and what buyers in the East are paying for real metal did not close on a day when every risk asset was getting hammered. Think about what that means. On a day of maximum stress, the Eastern physical premium held and widened. Shanghai Futures Exchange silver vaults shed another 3 metric tons on Monday, now down to 8.1 million ounces. Despite violent price swings across late January and February, No meaningful new metal has arrived to replace what has been pulled. You can manage a paper price. You cannot fabricate a warehouse receipt. The price mechanism for silver is shifting, slowly but visibly, from paper-driven Western trading toward physical-driven global demand, particularly out of Asia and industry. COMEX is not disappearing, but its monopoly over price influence is eroding in real time. Gold closed flat in Shanghai today at $5,123. Western spot is at $5,088, holding its structure even with everything hitting simultaneously. And the GLD story from last week connects directly to what is happening in the physical market right now. $4.2 billion left GLD in a single week, at near all-time high prices. Record paper selling. And the physical price did not follow it lower. When you cannot push a price down with record paper selling, the physical demand underneath is absorbing every offer. That is structural support, not fragility. And here is who is doing the absorbing. The Czech National Bank added nearly 2 more tons of gold in February, 36 consecutive months of buying without a single break. In late 2019, they held 8 tons. They are at 75 tons now, targeting 100. That is not a hedge. That is a reallocation. And the Czech Republic is not alone. The diversification away from dollar-denominated reserves has been one of the most consistent trends across 3 full years of data. A commodity shock that simultaneously raises inflation and pressures dollar credibility does not slow that trend. It accelerates it. The energy system and the dollar system are not separate architectures. Oil is priced in dollars, which means every importing nation must first acquire dollars to buy barrels. That creates constant structural demand for the dollar short term, but it also drives the long-term search for alternatives among every nation sitting on the wrong side of that dynamic. China receiving Iranian oil through Hormuz, while the West scrambles to coordinate a reserve release, is not a coincidence. It is a positioning move inside a much longer game. Energy, gold, and geopolitics are not 3 separate stories right now. They are one story told across 3 markets. Now the bear case. And we are going to give it to you with full precision, because this is the section that protects you from your own thesis. Paper markets still dominate short-term price discovery. The $85 rejection on silver has happened 4 times. Until that level breaks with conviction and holds, the range is defined. And if Sunday's $79 low fails on a renewed flush, the next structural support is lower. The algorithms running stop hunts do not read Shanghai premiums. They read order flow. The DXY gapped higher at Sunday's open and has come back into that gap. But there is still no closing body above the January 15, 2026 level on the dollar chart. That level is the line to watch with absolute precision. If the dollar closes above that level, the next tape reading objective is 150. That is the November 2025 high. And if the dollar reaches 150, paper metal prices will move lower, both gold and silver. But here is the distinction that most analysis misses entirely. Silver's downside sensitivity in a dollar-strength environment is greater than gold's, significantly greater. Silver is the most heavily paper-influenced market in the precious metals complex. When the banks get a window, through a strong dollar, thin participation, or a narrative shift, the paper price can be pushed well beyond what the physical fundamentals justify. The physical thesis does not change. The paper price absolutely can. And those are 2 completely different things that you must hold in your head simultaneously. Conflating them is exactly how people get caught at the wrong moment. The physical drain is real. The Shanghai premium is real. The vault data is real. None of that prevents a paper flush in a dollar strength window. Size accordingly. The macro data calendar this week is loaded, and every print lands into an already unstable market. CPI Wednesday, then GDP, PCE, and JOLTS all landing Friday. Any of those prints arriving hotter or colder than expected hands paper sellers exactly the narrative window they need. But the CPI print on Wednesday deserves particular attention. Inflation data dropping into an active oil supply shock creates a specific read that is sharper than a normal CPI release. If CPI runs hot on Wednesday, the Fed's response calculus gets complicated fast, because the market will be asked to price both supply-driven inflation and a war-driven growth slowdown in the same session. Bonds cannot resolve that cleanly. Neither can rate expectations. Respect the volatility. Short-term price action does not know your thesis. It only knows structure and leverage. Here is what to watch this week. Watch whether silver closes above $85 with conviction and holds it, or whether the ceiling holds again. Watch Sunday's $79 low as the structural invalidation level. If that fails on a renewed flush, the next support level is what matters, not the Shanghai premium. Watch whether the DXY prints a closing body above the January 15, 2026 level. If it does, recalibrate everything. Watch CPI Wednesday into the oil shock backdrop. Watch COMEX silver inventory reports. Updated daily, publicly available. LBMA statistics are published monthly. The G7 reserve release commitments, or lack of them, will develop through the week. France's trade minister's comments are on record. Watch who confirms and who does not. Verify every data point we have shown you. COMEX reports are public. LBMA statistics are public. Central bank purchase figures come directly from the institutions themselves. The people who verify primary sources are the people who do not get caught off guard when the event arrives. And before we close, here is the question worth sitting with. $4.2 billion of paper gold selling moved the physical price nowhere. The $85 ceiling on silver has held 4 times despite a weakening dollar. 3 private credit funds blocked exits in the same week. Oil reversed 18% on the possibility, not the confirmation, of a reserve release. In a market this volatile, moving this fast, with this many variables landing simultaneously, the only edge is understanding the structure underneath the noise. Not the headline, the structure. Invest with logic, not hype. Market Crux, signing off.